Good morning, everyone. So, over the next half hour, I'll try and run through how we're seeing the current world of commodities. I mean, it's been an interesting year, tough year in many cases. But we'll run through some of the general macro outlook, a little bit of some of the key commodities, and I will try and leave some time open for questions at the end for anything you may wish to ask. So where are we in the commodities markets? It's felt tough. It's felt tough for the industrial side, particularly because global industrial production growth, that is still going to be the end-use driver of many of the industrial commodities we look at, and it's been steadily grinding lower. It's not unusual. I mean, we've seen much more aggressive cycles in the past in terms of slowdowns, and we're still positive. That's the point to note. But you have seen there, we've gone from maybe 4% global industrial growth. Remember that synchronized growth? Everyone was growing at the same time back in early 2018. Well, Q3 2019 in our numbers is plus 0.9%. Still growing, but definitely at a lower pace. It's interesting, you see there, looking for 2020, we do have a little bit of recovery coming through. I want to run through some of the rationale for that. But it's this steady, slow grinding lower and the steady pressure on order books that many of the purchasing managers have been feeling that has really acted as a headwind to many of these industrial commodities. Now, look at the right-hand side, that's global trade volumes. Also, if you want a measure of how the global economy is churning along, and you can see there that having been positive consistently since the global financial crisis, look, it's gone negative. That is what a trade war will do. We're seeing a bit of a stagnation in trade flows, but it's interesting. There's some interesting subplot dynamics behind that. What happens in this type of scenario when you're seeing industrial forecasts pulled lower? Of course, you downgrade your demand. Obviously, we're just past London Metals Exchange Week. That was, 2-3 weeks ago here in London. And so I took a look at what our forecasts were for 2019 this time last year and what's actually come to pass for the major base metals there. And you see, well, global industrial production, lower than we'd forecast. For many of these base metals, basically no growth on the demand side this year. Nickel is a bit of the odd one out, and we can talk about the rationale for that in a little bit. But where are prices? Where are prices relative to, let's say, recent history? So this is current prices. I've basically taken the ranges there, normalized to today's money, so Q3 2019 if you want, in terms of the money. That's obviously the average, as you'd expect, towards the middle. But over the past 10 years, well, that's where current pricing is. Gold, above. Nickel, slightly above the average. All others towards the bottom end of the range. And that's part of the challenge. We're in the pricing and dynamic we're in at the moment is not great relative to where we've been over the past 10 years. That's why things are feeling a little bit hard at the present time. Now, everyone thinks, well, trade war, it's going to have a big impact on China. Look, I spend a disproportionate amount of my time looking at the Chinese economy, because if I get that right, it goes a long way to pulling these markets together. What's been happening in China in a trade war environment? Well, Chinese imports are down. What's interesting is that Chinese imports are down more than Chinese exports in a trade war environment. It's basically because China's got pretty insular. What you've seen is a situation where you're seeing consumer and a bit of capital good import substitution. Effectively, I think people still underestimate the patriotism we're seeing in China in a trade war scenario, in that there's a lot of push to buy Chinese goods. So first use of many end commodities, and more of that's taking place in China. But obviously, when China's had lower imports, it tends to correlate with periods of global industrial weakness. What's interesting, when people think Chinese imports lower, they tend to think commodities. That's not been the case. In fact, the China commodity business model, which I've talked about often in the past, of buying raw materials, having more than enough process capacity to convert them, and ideally exporting a little bit of the finished product as an inflation hedge, well, that's holding up well. Chinese raw material imports are up year on year across pretty much all the main commodities. Down a little bit in iron ore because of the Brumadinho incident, but for everything else, we've seen further growth again in the raw material imports, and I expect that to continue next year. Nickel ore, obviously with Indonesian expedited export ban, that will be an issue. So if you get supply constraints, that can disrupt the model, and that does tend to lead to higher pricing. But in the main, that China import model for raw materials will continue. So where have been the weaker areas? I would say there's two areas, ex-China and particularly in the consumer goods. I put up European steel demand there. European steel demand down 12% year on year on an apparent basis. Now, Europe's bad, and certainly the closer you are to Europe, the worse you feel about demand at the present time. But I don't think Europe's minus 12% bad. I think you have seen some at least passive, if not active, destocking at a purchasing manager side. But that's definitely been a drag. Auto sales, global auto sales are down. I'll talk about them in terms of the future a bit, but as of year to date, they've been lower. And we've seen other areas like mobile phone shipments, semiconductor shipments have also struggled. So it's mainly actually been the consumer side of the economy that has taken the hit so far. What it's left is, when I say ex-China has been weak, well, again, looking at this time last year, I expected a much more balanced growth dynamic between China and the rest of the world. As it's come to pass, it's basically been another year dominated by China. China's added 91% of the global industrial production growth that we've seen this year, and more than 100% of demand growth in some of these base metals. We still continue that trend where China continues to gain market share, particularly in the refined side and in the demand side of many of these commodities. Okay. What's happening in China then into next year? I was there last week, and there's certainly been some caution on the demand side, I would say. Obviously, Chinese demand has disappointed slightly relative to expectations this year. But two areas to look at. Number one, construction side. I just wanted to flag, we've had this very interesting trend in Chinese construction over the past 18 to 24 months. We've had positive new starts in terms of floor space. We've had negative completions. So in the China property market, we've seen starts positive, completions negative. Now, what you're seeing, of course, is a bit of an inflection point coming through. Let me explain why that's happening. Basically, the People's Bank of China went to the commercial banks earlier in the year and said, look, you have way too much of your loan portfolio out to property developers. Can you balance the risk, please? Because it is a systemic financial risk to us. So you've seen commercial banks pull back loans to property developers. Land purchases have fallen. New starts are starting to struggle, but in order to keep themselves funded, you're seeing completions pushed hard because that's when you get mortgage proceeds through. Now, why that's important is actually starts are good for steel and the steel-making raw materials and cement. And that's why I've actually had to up my steel demand number for this year relative to what I expected. It's been another year where Chinese property starts have been ahead of expectation. Completions has been a drag on the base metal side. Obviously, as you complete a building, that's when you put on the aluminium facades, you put through your wiring, your conduits. That's where a lot of the base metal demand comes through. That's been a drag, but now you're starting to see that pick up. So just tactically, we do favour base metal exposure over bulk commodities at the present time. Then I wanted to look at that right-hand chart. That right-hand chart is Chinese auto production. So China, as with everywhere else, has been weak on the auto side. What you're seeing there is a bit of a pickup coming through. You've got internal combustion engine production, which is a good indicator or lead indicator for auto production itself. Is now positive for the first time since early 2018. And that to us, with dealer inventories also quite low, you should see a bit of a pull through. It's interesting, just a comment the NDRC in China made a couple of weeks ago was that, look, if you exclude autos from retail sales have been fine this year. Now, the implication of that is if they're going to target an area for a little bit more policy support, it is likely to be auto purchases. So I wouldn't be surprised to see more scrappage schemes come through in China over the coming 6 months to try and bolster those auto sales. So I think you're seeing a little bit of more positive signs coming through in that market. Now, ex-China has been the problem. It's not a new problem. If you look at that right-hand chart there, I've indexed ex-China base metal demand back to 2006. With the exception of aluminium, they are all lower. So basically, we've had a lost, 13 years now in terms of ex-China demand for some of these base metals. And obviously, as purchasing manager indices have become increasingly negative, so that's weighed on near-term metals demand as well. Well, we've seen that. I would say Q3 was particularly bad for European and indeed Japanese and Korean demand for many metals. Now, where do we go from here? One thing I think really we're all going to start talking about a lot more over the coming 6 months is basically fiscal spending coming through. Governments have done pretty much all they can from a monetary policy standpoint. They've pulled that lever as hard as they're going to. Now we're starting to see them back that up with fiscal spending. Now, as I kind of term it, it's following the China model. It's basically taking everything on the government balance sheet and then worrying about it later. But global infrastructure spending has lagged global GDP over the past 10 years, and that's even with China's push. And basically because in democracies, it's very hard for governments to sanction big infrastructure projects, because effectively the return on them is always longer than a political cycle. What you're seeing a lot more now is proposals on Green Deals. So Ursula von der Leyen, for example, who's the new European Commissioner, is well known to be in favour of Green Deals because they're very popular with the younger voting demographic. They are willing to vote for a Green Deal, whereas they would not vote for a politician. So I think and there's also a lot of research out there to show that the Green Deals actually pay for themselves much quicker than standard infrastructure projects. So that's definitely an area I think you're going to see developed world start to push into a lot more. Now, if this was China, I'd be putting it in my numbers for next year. This is the developed world. Things take a lot longer, but it does at least turn sentiment. So what we're looking for in ex-China is just an end to destocking. Not looking for necessarily any particular organic pickup in demand, but just an end to destocking would help. Now, I just put it on the right-hand side there, electric vehicle charging stations. Obviously, I would say, I'll talk about electric vehicles in a little bit, but the hype has gone away a bit. But what we're starting to see is a lot more targets come out in the longer term. I've highlighted one there with the arrow. That's China's 2030 target, and that should be read on the right-hand axis. So that is chargers per million people. And you see, that is obviously strong growth from where we are. Now, Germany, a week past Monday, came out with a target which is 4 times that China target for 2030. So you're starting to see a lot more policies come through in that side. Do look for fiscal spending to at least turn around sentiment in the metals-intensive parts of many economies. But 2019, therefore, where does that leave us? Growth is sub-trend, but we are looking, if we look at where the long-term trend has been, and the grey dots and where it's going to in the kind of in the circles, we are looking at lower trend over the coming period. I think that is natural, given where we've been over the past few years. I see 2019 lower, and in fact negative in the cases of aluminium and zinc for global demand. I think that's been heavily influenced by destocking through value chains as global industrial production has grown lower and as sentiment has remained weak. But you look at, I've just put up the example of aluminium. It's probably the most extreme example, but how demand growth may change. You can see that's by decade, and you see the grey bars China, and that's the domination that China's had over growth over the past 20 years. As I look forward 10 years, I am expecting the other developing economies to perhaps be the larger positive delta. That's the ASEANs of the world, and eventually some Indian growth coming through. So we're seeing a little bit of a shift in the longer-term demand metric. Coming on to the supply side, what happens in this type of situation where we're cutting near-term demand? Well, we cut medium-term supply. Because, of course, what we have is a mining industry that's attracted in many investors by returns, particularly at the larger end of the spectrum, and that capital allocation back to shareholders will not be cut because that's what's keeping people holding the equity. So therefore, if, let's say, commodity prices are a little bit lower than may have been expected, we go to a situation where we're still cutting growth projects. And if I review all the kind of 200 metals and mining companies that BMO cover, our expected 2020 growth capex is about 10% lower than we would have expected this time last year. And that includes the gold industry, which is, of course, making a lot more money than it was back then. So you are still seeing growth projects cut. We're still pulling down medium-term supply growth. So that's an interesting one to note, and that's obviously that's just the major diversified miners who tend to lead the global cycle. And you see there the step change down in growth capex that we're seeing. Many of these big companies now are ex-growth and probably have to start looking at addressing that in the coming period. I just wanted to highlight something else in terms of longer-term trends. That on the right-hand side there is the change in the 90th percentile of the cost curve since 2004. So basically since the China boom started taking off. And you can see there, in my view, there's a bit of a dichotomy. You've got the process capacity metals, if you want, the ones where we're getting better at processing all the time. That's aluminium and nickel via nickel pig iron. And you see there, you have seen some inflation in nominal terms in the top end of the cost curve, but in real terms, it's not very much. And then you look at those which are more mine supply constrained, zinc, gold, iron ore, copper, and obviously we've seen some pretty hefty inflation at the top end of the cost curve. Cost curves getting steeper over time is generally what commodity analysts like to see. So you do have that dichotomy. I think that generally continues. Okay, talking of dichotomies, one other one to flag is what's happening in China itself. We talk a lot about Chinese demand, but of course China very important on the supply side of many of these commodities. Chinese mine output's falling. With the exception of coal, Chinese mine output is down for pretty much everything I cover on where it was 3 years ago. And that's a function of banks not lending to private sector miners. It's a function of higher environmental hurdles. But I think it's an ongoing trend, and I think one you'll see more of. You'll see more and more cuts to Chinese supply. I think many consultant estimates out there for Chinese mine supply growth are way too optimistic, and you'll see them disappointed over the coming period. So you're going to see less and less Chinese mine supply, but of course, I talked about it earlier, China's still dominating refined output. It dominated refined output growth again this year. We've seen, again, in a stagnant copper market, 3.6% growth in Chinese smelter output, and you've seen a 3.6% reduction in ex-China output. The Chinese refined capacity is bigger, more environmentally friendly, more power efficient, and it's newer. And with that, you're going to see more and more, I think, of that midstream part of the chain shift to China. The ones which are odd there, maybe Indonesia is growing in stainless. That's been why you've seen that ex-China recovery. And the other odd one out is actually aluminium. That's where you have seen Chinese supply cuts come through this year, whereas ex-China is still growing. Before I go on to the individual commodities, I just wanted to highlight a couple of things on the asset allocation side, because we talk about fundamentals a lot. Like financial markets do have an influence, and maybe a bit more than we give them credit for. What I've flagged on the left-hand side there is, in the blue line, that's your largest emerging market ETF. It's a passive ETF, the iShares Emerging Market ETF. And I've put it up there against the London Metals Exchange Index. And what you can see is they move in lockstep. Asset allocators, they've always played a big part in the gold market. They're having an increasing influence on other markets as well. So just bear that in mind. While fundamentals will always come to bear in the end, in the short term you may get financial market influence. And you've seen it in, let's say, the copper financial market positioning, or that's the CFTC data. You see, as we've had periods of escalating trade friction, and you could put the inverse up for gold, by the way, you've seen that industrial metals are out of favour with asset allocators. Increasing short positions coming through. Obviously, that flicks around on trade war sentiment and trade deals, but in the main, it's still the financial market's trying to sell you industrial metals at the current time. Let's move on to some of these individual metals. Copper, it's an interesting story. So, the left-hand chart shows the copper project pipeline. Fewer projects, less capacity than we've seen at any point in this century. Right-hand side shows the capacity being built. Basically, miners love building copper projects, and that's the way to think about it. You're seeing actually 2 million tonnes almost of new organic capacity come through. Of course, as the copper price got above $7,000 a tonne last year, we saw a lot of projects approved. QB2, Quellaveco, so we've got Spence, we've got the Palambras expansion. We have a lot of projects coming through, basically from 2021 to 2024. Now, beyond that, we do have quite a lot of a fair bit of a supply gap that's building. Look, in copper, we will need new projects to balance the books in the medium term. But we are, from a 2019 and 2020 deficit, we are moving to a market that's going to have to absorb a fair bit of capacity growth over a 3 to 5 year view. So to me, I'm not expecting to see too many new copper projects approved at the current time. I have to say long run pricing, I'm at $3.25 a pound, or that's $71.65 in dollars a tonne in new money. Still pretty confident in that, and I actually think there's probably some upside risk to it. But for now, look, we're still trading below that. It's difficult to see more new projects approved in that type of market. But the longer term demand dynamic is still pretty positive. We talked green deals before. Look, renewable energy is a big growth area for the copper market. That's growth we're seeing in offshore wind installations. And why do I put them up there? Well, they're very, very copper intensive. And it's pretty simply just the amount of cabling that's needed. All these 20-kilometre offshore wind turbines all need copper cables linking them back to shore. And that's just an example from EDF's Norfolk wind farm, just from their centre there. Look, 32 millimetre diameter copper cables linking everything back to shore. So if I put that in numbers, well, actually I'm seeing about a 1.6 million tonne delta on an annualised basis for copper in the renewable energy side, and obviously any green deals might accelerate that process. Coming on to nickel. Nickel is the bane of my life, and it's mainly because Indonesian policy changes on a daily basis. Just to flag something, nickel, I mean, the general trend has actually been a bit of cost deflation, as I highlighted before. Chinese NPI plants, nickel pig iron plants, with the RKEF technology, is much more energy efficient than we've seen in the past. But we've had two things here. We had the Indonesian ore ban in 2014, supply shock, and supply shocks do get inflation through commodity prices, and we saw $6,000 per tonne delta. And this year with the expedited Indonesian ore ban, we saw exactly the same again. Now actually short term I'm pretty cautious on nickel. Chinese stainless steel inventories are very high. The ore price, the nickel ore price, which bear in mind is where we should see the constraint in the supply chain, is actually falling at the present time. That plays into the cost of making nickel pig iron, which in my view anchors the nickel price. So I'm a little bit cautious there. Longer term, the biggest impact from the Indonesian ore ban is on 2021 onwards. I have enough ore supply and an inventory to see me through 2020, but beyond that is when you start to see Chinese NPI falling. Yes, Indonesian nickel pig iron is growing, but that's when we can start to look to see a more sustainable nickel price above $15,000 per tonne. I just wanted to flag, I mean, if we were sitting here 2 years ago, we'd have been talking batteries for most of the presentation. Obviously, a lot of the hype's gone away. We are in an EV downgrade cycle at the current time, mainly because near-term Chinese sales have been a bit disappointing. Secondly, because everyone's revising down their auto sales forecast, i.e. their global auto sales numbers. We've moved ours from 110 million light vehicles in 2025 to 103, and even if you keep the penetration rate the same, obviously with your denominator coming down, that does play into demand. So we've reduced our nickel demand in electric vehicles by about 75,000 tonnes in 2025. So just be aware we're in a little bit of a downgrade cycle for that at the current time. Aluminium, look, it's in a deficit. It's the most dreary deficit you've ever come across. We've been running down inventory at about 1 million tonnes per annum over the past 2 years. But the challenge is the demand side just hasn't been there. Deficits don't really matter without demand growth. I do think with the push for completions in China, look, you will see a slightly better demand environment. But having been at an aluminium conference in China last week, you're getting a lot more deflation to the raw material end of the value chain. A lot of investment in Guinean bauxite and logistic capacity to get that to China, and a lot of development of aluminium capacity in Yunnan province, which is hydropower. China's going to lead green aluminium because you're seeing so much more hydropower-based capacity added. So with that, it's a market you always struggle to get too excited about. It is in a deficit. It is just one where we need to see demand growth come through, and it's been painfully slow to do so over the past little while. Gold, right, better spend a bit of time on this. Gold, definitely driven by asset allocation. We're very much in a precious positive environment. What drives the gold price? Quite frankly, it's ETF holdings. That is your marginal buyer and seller of gold on any given day, and it therefore has a disproportionate amount of impact on the price. And therefore, I mean, how do we think about it? We're trying to think of what macro asset allocators are trying to do. In a world where yields are still pretty tough, in a world where geopolitical risk is high, you naturally see defensive positioning, and gold tends to benefit from that. So we've seen this push in ETF holdings. They were recently at the highest level we've seen in history, and that has been supportive of the gold price. Now, what I would say is the aggression we saw in Q3 is unlikely to be repeated. I view that gold moves in ranges, and we're now in a $1,500 per ounce range, probably plus or minus 75 for a little while. To move us out of that on the upside, basically the world would have to be going to pot from an economic standpoint, which is possible, but it's something to look for. To move it on the downside, it would really be a risk-on environment. We've seen a little bit of short-term risk-on recently, as short-cycle industrials have done well. I don't see us moving into a full risk-on environment, certainly over the coming period. So gold, to me, is in a good range now at 1,500. That's a good price for a producer, particularly in many producer currencies. It has helped the consumer. You see China and India gold imports have actually been declining, and actually barring coin demand has been at an 11-year low. But this is the interesting thing. This is a turnaround. I've drawn this chart a few times over the years. Basically, x-axis margin over all-in sustaining costs at $1,500 per ounce gold. But the y-axis, maybe more important, net free cash flow yield. The gold industry is actually making money for the first time in a while. Now, what is interesting is that, S&P released their latest exploration statistics yesterday, and gold exploration is actually still falling. There's definitely discipline coming through in the gold market. Now, obviously, a free cash flow yield of, let's say, 5% is still not enough to get generalist investors overly interested, but it is moving in the right way, and at least I would say we're seeing the gold industry viewed as a lot more disciplined than it was in the past. So that the dynamic is moving in the correct way. Now, of course, we still have a situation where macro asset allocators can get much easier access to gold bullion than they were able to in the past, and therefore maybe don't have to go to the effort of understanding an equity. And that has been a derating factor. But if we get a couple of quarters of good, solid free cash flow coming through from the gold industry as a whole, I think that will start to gain a lot more interest again. Very briefly, because I do want to leave time for questions, on steel. I'm pretty negative on steel into next year. Chinese construction and new starts are the main reason, as we talked about before. I do think they go negative, and in fact, we are heading for negative year-on-year metrics. And I've flagged there, we've got steel-weighted PMI, and you see global steel consumption against that, both falling now. So I'm still pretty cautious on that into next year. In terms of iron ore, obviously that was the story of early this year, and you can see early in the year we had this, perfect storm almost of lack of supply coming now. Not good for the mining industry that came from Brumadinho, but also we had Australian supply falling away. That has recovered. Iron ore is the most efficient commodity market out there. Price allocates resource in very short order because effectively there's nowhere you can go and store inventory. What have we had? This is how I look at balancing the iron ore market on the right-hand side. What's your supply change? You can see the period where all the majors were growing, where we displaced about 200 million tonnes of incumbent supply. Well, now, for the past couple of years, we've been trying to incentivize supply back to the market. That's what the price has been doing. Into next year, with falling steel production, look, we're trying to displace a little bit of supply once more. And therefore, I do expect the price to come down. We're looking around $75 to maybe $78 a tonne as an equilibrium. The price will cycle around that. That's very profitable for the industry as a whole, by the way. And that is the sort of price level that could get new projects built. But I would say we're looking at a lower year-on-year price just as the supply normalizes and demand falls away a little. Just lastly, on the battery side, look, it is still a growth area, but as I said before, the hype's kind of come out. There's our right-hand side, that's just copper and electric vehicles. You can see still very strong growth there. The biggest problem for the battery sector has been the left-hand side. Portable electronic sales were down for 7 quarters in a row. Now, they have just pushed back into positive territory, but it's still very, very low growth. So your core demand, if you want, has been struggling. Obviously, I do think we're now starting to see the supply cuts coming through in many of these sectors, which are probably what's needed. Supply cuts tend to act as a floor in commodity markets. Now, the problem is that supply can, of course, come back if prices do rally, but at least that tends to mark a bottom. I think you will see a little bit more interest coming through from the investment community in the battery sector as we head into Q1 2020, particularly as you get new electric vehicle models launched. I'm just going to leave up there. That's our standard commodity comparison chart. Basically, the x-axis is potential for long-term shortage, y-axis potential for short-term constraint. It's just an effort to try and put where things are on the chart. Things do move around on there. But with that, thank you very much for your attention. I'm happy to, I think I'll probably get 2 minutes to take some questions. Thank you. Oh.
Hi, Colin.
Hi, Michael.
Just a quick question on 5G. Do you think the 5G revolution would lead to an uptick in mobile phone sales next year or the year after?
Thank you, Michael. Yeah, so 5G is an interest. So the question was on 5G. So 5G is an interesting one. Normally, you get the 5G build out, and then the handsets upgrade cycle comes about a year after. That's what we saw for 4G. Of course, we're now getting the 5G build out now, so we are expecting to see higher smartphone sales over the coming period. So we're expecting to see a bit of a turnaround in that cycle. That obviously will help the cobalt market, particularly given the LCO chemistry that remains dominant there. That, in my view, has been the big headwind to cobalt. Just interesting, the other thing for 5G, it's very positive for silver demand. Silver is used as the electromagnetic shielding around 5G base towers. Now for 5G it's higher frequency, so you need more shielding, and secondly you need 4 times as many base towers, so that is very positive on the silver industrial demand front. I think we have one more question. There's one down the front here. Sorry, John. John, do you have a question?
There's a lot of interesting graphs in your presentation. Is there a way of accessing them so one can pore over them in time, one's own good time?
Yeah, we can distribute a PDF. Yeah.
Have you got some you could send me?
It will come from the one-to-one guys.
You've got some copies, have you? Yeah.
You like it as well? Yeah. Yeah, we'll try and distribute all of the presentations, provided everyone's happy to share them around, all of our presenters. Do we have any final questions for Colin on Commodities Outlook? Any picks you wanted to ask? No?
Yeah. Thank you very much, everyone.
Let's have a round of applause for Colin. Thank you.